All right, hello everyone. I have 3:30 Central Time, so we can get started. Welcome to the monthly market monitor for today, February 9th. My name is Adam Stone. I'm the Vice President of ALM Investments with Corporate Central and their QSO Quantify. Today, I'll give a quick overview of economic highlights from the last month, and I'll start off by reviewing some of the economic releases that came out. I'll go chronological order. So I'll start the day of our last market monitor, which was January 12th. So big one came out that day. Inflation numbers, the consumer price index or CPI was shown to increase from 6.8% up to 7%. The forecast had been for 7%. So even though that 7% is a very high number, it was in line with what everyone was expecting going into that announcement. You can see some sectors that were up big: energy, gas, shelter, food, new and used vehicles. So a lot of the same categories that we've been talking about for months now continue to increase. And the red box there shows some of the main reasons we saw inflation spike in 2021. Nothing new here either. Pandemic-related supply constraints, rising energy costs, labor shortages, and then, of course, the low base amount from 2020 causing the higher year-over-year changes. Core inflation came out the same day. The core CPI is everything in the CPI index except for the food and energy costs. So even that is really elevated. If you look at this graph that goes back 25 years, you see it typically hovers in the 1% to 3% range. We're up now to 5.5% in December. That was up from 4.9%. The forecast had been for 5.4%, so it was slightly higher than expected. Big release coming out tomorrow morning before market open. The overall CPI expectations are at 7.3%, and the core amount at 5.9%. So all eyes are on what those numbers are going to be tomorrow morning. Retail sales dropped from a 0.2% increase to a 1.9% decline month over month in December. It had been going up for 4 straight months. You see some of the main categories that showed drops there. Non-store retailers, so think your Amazons of the world, down almost 9%. Also furniture, sporting goods, clothing, electronics, general merchandise. So a lot of categories fell during December. On a year-over-year basis, retail sales are still up almost 17%. So retail sales track the dollar amount of goods sold through retailers. So inflation has a big impact on that. The same amount of retail sales good at higher prices will show an increase in the retail sales dollar amount. So up 17%, half of that, or roughly maybe due to inflation, the other half due to actual increase in demand. Consumer sentiment shown here through the University of Michigan Consumer Sentiment Report dropped from 70.6 to 67.2. This index has 3 main components that they poll consumers on. One being, how do you view your own financial situation and outlook for the future? Another one being, what do you view the economic prospects over the short term? And then how does a consumer view the economic outlook for the longer term? So this graph you see here goes back 25 years. It had been, in the early 2000s, up in 80 range, dropped during the housing bubble crash in 07, 08, down to 60, steadily increasing to 100, sharp drop during COVID, and a little bit of a rebound, but now dropping down further to 67. Moving to housing, building permits here were up almost 10% in December to 1.885 million annual rates. The expected level was 1.7 million, so up a little bit more than expected. Something that I found interesting here, more than 1/3, 34.1% to be exact, of single-family homes for sale in December were actually new construction. That's up from 25% a year ago and the highest amount on record. So there is a lot of new homes being developed and being built right now. Housing starts up 1.4% in December to a 1.702 million annual rate. They were up in the Midwest and the Northeast and down in the South and the West. If you look at that red box down there, you see most of the increase in December was due to a 13.7% increase in multifamily units. Single family homes make up a greater proportion of the total, but they fell 2.3%. But that large, almost 14% increase in multifamily units dragged the entire index up 1.4%. Existing home sales fell 4.6% in December to 6.18 million annual rate. They were expected to be closer to 6.5 million. So that was a lower than expected number. They fell in all 4 regions of the country. So this was a December reading. So we can now say that for all of 2021, sales are up 8.5% to 6.12 million annual rate, the highest since 2006. If you look at this graph, this also goes back 25 years. You see a steady increase from before the year 2000 of about 4 million, increasing up to over 7 million in 2006, and then dropping sharply during the 07-08 housing market crash, down to 4 million again. Kind of bounced around, but it had been generally increasing outside of that COVID crash and recovery. So we're up to pretty high levels again. I don't want to call it a housing bubble we're in now. The situation is drastically different than the largely underwriting bubble that we saw in 06, 07, but the housing sales and housing prices are up again. The composite PMI shown here, the IHS Markit US Composite PMI Index dropped from 57 to 51.1. This index tracks business trends in both manufacturing and the service sector, with the majority of it coming from manufacturing. And anything you see above 50 shows that business is expanding, and anything below 50 shows it's contracting. So 50 is kind of that break-even level. You look back, this graph goes back to 2014. It had been kind of jumping between that 50 and 60 level. Again, COVID caused it to crash below 30, recovered pretty quickly, and actually rose up to over 70. But we're trending back now towards that 50 level. If we break 50, it shows a contraction in the manufacturing and service sectors. Another big release on January 26th, the FOMC, the Federal Open Market Committee, held their meeting, released their minutes. Powell gave some statements. So all market eyes were on this leading up to this date. As expected, they held the current Fed funds rate at 25 basis points, or more accurately, a range of 0 to 25 basis points. The Fed, leading up to this meeting and coming out of this meeting, is expected to start raising rates in March. They're also expected to start reducing their almost $9 trillion balance sheet. They're going to do so by reducing their security holdings. There was not a lot of new information, no surprises, no real forecast of what they're going to do going forward. Nothing that we didn't already know, at least. Chairman Powell did say in his statements that he remains very concerned about high levels of inflation, thinks they're going to persist, and noted that officials, they have not made any decisions yet about the path of policy. They want it to be nimble. That said, everyone expects them to start raising rates soon. It's just the severity and the swiftness at which they're going to do so that remains unclear. So this is a Fed funds forecast of what the market participants are expecting the Fed funds rate to be. So you see the first meeting date there is March 16th. That's next month's meeting. And they're expecting a 1.35 rate hikes. So that can be read as 1.35 25 basis point rate hikes. So essentially the market is expecting a 100% chance of a 25 basis point rate increase and an additional 35% chance that they're going to increase 50 basis points at that first meeting. Again, the CPI numbers are coming out tomorrow morning. If they come in higher than what was expected, you likely see a larger number of people pushing for a more shock and awe type of larger initial rate increase than the 25 basis points. And you see the additional meeting dates the one in May, June, July, going forward throughout 2022 and one in 23, the number of hikes they're expecting. So by the end of 2022, coming out of that 12-14 meeting, expecting 5.4 rate hikes during 2022, which implies an implied Fed funds rate at the end of this year of 1.4%. I threw a table at the bottom to show what investment banks are predicting as far as rate hikes, just to show that there are a wide range of speculation of what the Fed's going to do this year. Some banks only forecasting 3 rate hikes, some as many as 7. So there's a lot of uncertainty going into the March Fed meeting and throughout 2022 of how much and how quickly the Fed is going to choose to raise rates. The Fed themselves say at this point they haven't made up their minds. They're going to wait to see maybe how the inflation numbers look tomorrow and moving forward. If they need to do a more drastic action than a single 25 basis point hike now, we'll wait and see. Durable goods orders came out January 27th. They dropped 0.9% month over month in December. So this tracks the orders of goods that are meant to last at least 3 years. Something that a lot of people look at is that non-defense capital goods, excluding aircraft, so that strips a lot of the volatility from these numbers. That was unchanged in December, excuse me. Orders for transportation equipment down almost 4%. Orders for computer and electronic products down almost 3%. GDP, the fourth quarter 2021 GDP number came out in January. It showed U.S. economy grew 6.9%. In the fourth quarter, that was up from 2.3% in the third quarter. The expected rate had been a 5.5% increase. So that 6.9 was actually quite a bit higher than people were expecting. A big contributor of that was private inventories, especially car dealers, which have been able to replenish some of their inventories, which were really at historical low levels for a while now. Personal consumption also increased 3.3%. Led by 4.7% increase in services spending. So that's things like healthcare, recreation, transportation, restaurants, movie theaters, what have you. For all of 2021, GDP grew 5.7%. So it was the most since 1984, but remember, it's a year-over-year figure coming off a low base 2020 number. But nonetheless, it was a strong recovery in 2021 from a GDP perspective. Personal income was up 0.3% month over month in December. Both private and government wages and salaries were up. The 0.6% increase in overall compensation was dragged down by a 1.4% drop in proprietors' income, which is just a fancy term for the income from business owners. So you saw general payroll compensation up 0.6%, where business owners saw a decline in income. Personal spending was down 0.6% in December. It was the first drop in 9 months due to a number of factors. The Omicron COVID variant continued to spread around the country. And then largely, I think people were afraid going into the holiday shopping season of supply constraints and not getting their holiday presents delivered in time. So a lot of the spending for that was pulled forward into November, and then December it was a lower amount than you would typically see around the holiday season. Moving to employment stats, job openings were up to 10.925 million in December. You see some categories there: accommodation, food services up, information, non-durable goods, and then education job openings all increasing. So the number of openings we have right now are close to record highs. It shows that many employers still having a tough time filling their open positions. Now we have two payroll reports coming up. The first one being the ADP employment change number. So this was expected to increase by over 200,000, but instead it dropped by 301,000, which was a surprise. You see drops in services, trade, transportation, utilities, education, health, finance, kind of all across the board. The employment numbers were down and across all company sizes too, small, mid-size, and large. And then 2 days later, another report, this non-farm payrolls report came out. It had been expected to increase rather modestly, 150,000. The number came in with a 467,000 increase, which tells a very different story from that ADP employment report that came out 2 days earlier. So wanted to take a closer look at how those two separate employment reports are calculated. So the ADP comes from the automatic data processing, payroll processing company that comes from 24 million data points of employees. And the non-farm payrolls report is more of a survey of 141,000 businesses. So they have different methods to pull their data. Typically, at least the trajectory or the trends you see between the two are similar, even if the numbers are different. So to show one with a rather large decrease and one with a pretty big increase is rather unique. We'll see if that holds or or reverses to form next month. The unemployment rate increased from 3.9 to 4% in January. The 3.9% had been a pandemic era low. It increased, ticked up very slightly to 4%. On a year-over-year basis, unemployment rate is down by 2.4 percentage points, and the number of unemployed people has dropped by 3.7 million. If you look at this graph, it goes back 25 years again. You see the unemployment rate, increasing steadily in the early 2000s and then slowly tapering back down during the 07, 08, 09 crisis. It increased up all the way to 10% and then a much slower taper down for the next 10 years, down to below 4%. Then the pandemic hit, it spiked to about 14, quickly reversed, came back down to 7, 6, 5, and now we're around that 4% number. So interesting to see with the unemployment rate and some of the other employment trends that we just talked about, how this plays out. All right, moving to some market rates. 1 month LIBOR, this graph goes back a year. It shows fluctuating between really 7 and 11 or 12 basis points throughout the year, dropping to lowest low of just over 7 in the summer, trending upward a little bit in the fall and in this winter. You'd expect to see 1 month LIBOR continue to trend up as the Fed raises their short-term rates. 2-year Treasury had been hovering around that 20 basis point level for most of 2021, then leading into fall and now into winter with the speculation of the upcoming rate hikes. 2-year Treasury, the short end of the Treasury curve has increased faster than the longer end, kind of flattening the curve in anticipation of those rate hikes. So similar, though less severe action in the 5-year had been hovering around 80 basis points, now up to 1.8%. 10-year had been about 170 in the spring of 2021 and dropped off during the summer down to 120. Kind of been fluctuating a little bit, but starting December, Jan, now into February, it has increased about 50 basis points during that time, up to, I think it closed today around 1.95%. 30-year Treasury, like I said, that the short end's moving up faster than the long end. 30-year up to 2.2 right now. It had been as low as 1.7 in early December. So next, I wanted to take a closer look at the 10-year Treasury yield specifically and layer in the 17 economic releases over the last 30 days that we talked about at the beginning of this call. The purpose of this was try to see if we can see any predictive trends based on the economic releases. So if you look at this graph, there's a circle for each release. Red means that that number came in worse than the consensus forecast. Green means it came in better, and yellow means it matched what was expected. So you see the 10-year yield rising or falling off both good and bad news. Sometimes when you saw a economic release that came in better and you would expect rates to move one way, they moved the other way, and vice versa. The 10-year started a month ago around 1.75. It finished around 1.95. So the 20 basis point roughly increase in a month isn't too dramatic, but you see it swung up and down quite a few times during the month. The point being here that there's a lot of more macroeconomic releases that come out during the month, some macroeconomic factors, some Fed statements, inflation numbers. It's hard to predict what rates are going to do based on that. People always say markets are efficient, everything's always built in. That may or may not be true. I think a lot of times what people see the consensus isn't what's built in, it's some other number. So if it comes higher or lower the consensus, it may not move the direction that you're expecting. Point being, we always encourage a more interest rate neutral strategy to take advantage of the waves up and down. Take advantage of rising rates and falling rates. Don't try to predict rates going forward and position your balance sheet to a certain future interest rate environment that's setting yourself up for a difficult time. It's much wiser to be more interest rate neutral, understand the risks in both rising and falling rates, and position your balance sheet, its loans, investments accordingly. Quantify had a webinar not too long ago where there was an interesting graph that showed over the last several decades, every time the Fed has tried to raise rates, the market kind of forecasts where the expected path of those rates are going to be. And not a single time was the Fed able to raise rates as quickly or as high as they had anticipated. There's always some external factor that's unknown at the time that rates start to rise that impacts their ability to get rates as high as they may have wanted to. I'm not saying that's going to happen this time. The high inflation numbers that we're seeing are certainly different than we've seen in previous periods. So maybe they will increase rates significantly this time, or there may be something that forces them to stop the rate increase or even reverse trend. We don't often talk about stock markets on this call, but I wanted to bring it up because there was a pretty significant drop in stock indices during January. So the S&P, the NASDAQ, the Dow saw close to 10% drops in January. It started to recover late January, now into February. The indices I saw were up again today, but the drop coming out of the new year during January dropped us back several months of gains. So I wanted at this graph to show the same thing that we were looking at with the 10-year Treasury, to see if we can see any trends with the major macroeconomic news as it relates to the stock market. The outcome really is, again, stock prices are even more difficult to forecast than bond prices. Besides the more macroeconomic factors that impact bond prices, stock prices are also fluctuate wildly by company valuations, earnings, projections, and just a really hard to quantify kind of sentiment factor about individual company stocks as well as the market in general. It's been earnings season lately. We've seen a lot of really high mega market cap companies report really good earnings, sometimes even beating estimates, and their stock takes a hit. So it's been volatile in the stock markets. The one thing that I thought was interesting in this graph is the number 9 listed there in yellow represents the Fed meeting, where you saw the stock market really decline rapidly leading up to that meeting. I think a lot of those market participants were worried the Fed was going to do something unexpected or something drastic with regards to their interest rate policy. Higher rates are generally not a good thing for stocks, especially growth stocks. Late last year and into this year, we kind of saw a value rotation from growth stocks into value stocks in anticipation of the higher rates. we may be seeing that reverse again back into growth stocks right now. But you saw stock prices drop leading to that number 9 there in late January as people were afraid, they were unsure what was going to happen. Then the Fed meeting came, and really they didn't say anything that wasn't already known, and they didn't predict anything going forward. So it took a little while for them to digest that, but then they determined that, maybe it's not the end of the world, and you've seen stock prices go back up. So point being, there's a lot of economic data that impacts both bond and stock prices, but there's an overarching kind of sentiment and unknown factor that makes it really hard to predict. So we quantify, don't try to predict rates, and we recommend you don't either. We like to position of interest rate neutral, take advantage of both rising and falling rate environments. That was all I had for today. I didn't see any questions come through, so I'll leave it there. And we look forward to talking with you a month from now about what happens in the economy during that time. Thank you.